Good morning. I'm Vince Lansing, and this is the GoldFix Market Rundown. It's 8:18 Thursday, and there's our homepage. We would recommend that you take a look at Japan's #1 gold dealer restricts physical, moves to cash settlement. And for those of you that are founders, the next equity thing is here. Of course, we had some news yesterday about Tulsi Gabbard basically blowing holes in the Russia gate hoax. But let's stay with the markets. 10-year yields are 440 up 2. The dollar is 97.33 up 13. The S&P 500 is 63.67 down 2. The VIX is 1520 down 16. Gold is 33.61 down 25 after yesterday's drubbing. Silver 39.07 down 21. Held very well yesterday, but here we are at $39. Not a bad place to be. Copper 580 up 2, still strong after yesterday. WTI 66.77 up 35. Natural gas 313 down up 7. Bitcoin down 300 at 118 spot 500. Ethereum 36.35 hovering. Palladium down after bucking the trend yesterday. Platinum down. Gold, silver down again. All right, and grains are mixed again. We're going to take a look at the story's not even on the front page, but let's take a look at it anyway. Here we go. Today we're going to discuss gold's new role beyond crisis hedging, and we'll get into yesterday's activity as well. To start off, let's throw a chart up there for some graphics up there. Make it a little bit easier to see. In a reflection of long-term price performance, gold has quietly outpaced the S&P 500 over the past 20 years. This inversion of conventional financial wisdom, where static metal has exceeded the returns of equity-based enterprise, is striking. According to DataTrek, gold's price return stands at 616% for those 20 years, and the S&P 500 delivered 421% over the same time period. The outcome challenges the embedded assumption that equities, as vehicles of productivity and innovation, should outperform inert stores of value. Pet rocks should not do better than humanity's genius. The past 20 years can be broken into 3 errors performance-wise. DataTrek does that. It's kind of interesting. In the first error, between 2005 and 2014, we'll call that a crisis error. Just going off my script here for a second, you could see 2005, 2019, you had the great financial crisis, you had the Euro crisis, and you had a general beginning of deterioration in faith in financial institutions. And then the next era, you have a reassertion of man's inventiveness. 2015 and 2019 could be called, we're going to call it a Goldilocks era for stocks. You had a nice recall back to how things were, and stocks outperformed gold, but gold actually performed well. Well, not well, but well compared to what you'd think. The point that DataTrek is implying and that we're going to make is that the inverted relationship is disappearing, and that's not. We'll put it this way: it's still there, but it's also being augmented by the new era. What the new era is, it's a reserve asset, and that's this era right here. Post 2020 is most interesting in that it represents a break from historical patterns. Yes, you have the inversion when gold rallies, when stocks drop, but you also have gold rallying while stocks rally, and we're not even in the QE era anymore. So while gold has traditionally excelled during volatility, it is now showing strength even when equities are stable. Central bank demand is the manifestation of old central bank manifestation is the manifestation of this. Gold is functioning both as a hedge and as an alternative reserve asset in a shifting global financial order. The full analysis is in the premium post, Gold's New Role Beyond Crisis Hedging. And there's a nice little chart in there describing 100-day rolling averages, and it breaks the errors down very cleanly. So moving on. Yesterday, we put out a bunch of posts. The second one there is kind of a real-time post that we sent out because, well, gold dropped and there was a legitimate event-driven reason for that. And that event reason was a rumor, not rumor, but more like a leak coming out of the FT that we're close to a deal with Europe. And that news was leaked at or put out at 11:45 or 12 o'clock after London closed, which means all morning the banks were positioning themselves for that. And we'll get into that in a second. Major banks are going to offer blockchain money markets. To our comments that we think stablecoins and blockchain are going to be very important. And there's the original version, Founders AM Gold versus S&P 500 data set. That's the unadulterated version for everyone. All right, so coming soon, China's M1 growth is going to obliterate Western inflation targets. Another Founders piece that we put out about a week ago, and we're going to put it out for premium today. And we're doing that because there are signs that this is happening, what we're talking about here, which brings us to the news. China's investment banks have slashed fees for bond issuers to as low as $100 as price-sensitive state-owned issuers dominate a tepid credit market and stake a race to the bottom to win mandates. So this is another capital control or fiscal, like lowering margins. They want money to flow faster. They're printing more of it and they're letting it into the market. And this report tomorrow will explain that better. There's another piece we saw out today by ANZ Bank, and they're starting to see it as well. Anyway, that'll be out tomorrow. The rest of the news, however, is well, let's just say it. Trump will personally participate in the tour of the Fed headquarters on today, as the White House ratchets up pressure on Powell to lower rates. So whenever he's going to go in there with a pay gun like an entourage. Trump also signed AI executive orders to fast track big projects and to turn America into an AI export powerhouse. See, we're not going to be exporting any manufactured goods. We're going to be exporting access to our data centers, natural resources, at least not now. One other one. Sorry, I'm looking at a table here from on Twitter from Zero Hedge. White House officials told Reuters that the administration was not denying that President Trump's name appears in the Epstein files. Okay, so the news that came out after that is we're going to have a deal with Europe, which is the reason that gold is down. And the Russiagate thing is potentially coming to a head. And now there's all other news to that effect. Trying not to be too cynical about it. But there's the data. Today is Thursday, so PMI, which is going to come out in about 4 minutes. And Friday is durable goods. Let's take a look at the charts and go through a little bit of what happened yesterday. Okay, most of you are gold people, so you know what happened yesterday. Right? Gold got close to that high. There's that yellow line. Gold got close to the highs, and news came out, and the news was bearish. And the news was bearish because there's one less unknown potentially coming out of Europe on trade. And I guess that's a big deal. Now, do I think gold overreacted to that? Yes, I do. But it reacted to it. So that line matters. And that line matters as it has mattered before because, and we said this on Sunday in the founders discussion, we said there's like a range now. There's two shelves. There's a shelf and there's a shelf. And the shelf above we believe is a real, the selling above is real. We don't know why. We don't know where it's coming from. It could be producers. It could be the good old BIS. I don't know. I don't think so. It could be because this is their pattern. It goes here, it retests, and it never breaks it. But scapegoating aside, there's real selling there. And that selling was waiting for a rally to hit it. Maybe it was going to back off. But the news came out, and the news was just enough to knock the market down. So we're still in the range. I warned you that yesterday. That the signal that I had, that daily signal negated, right? Completely negated. So you should assume that I'm out. Even if I'm not, you should assume that I'm out. Silver held up. You know, I want to comment on yesterday's activity. Before this news came out at noon, silver was unchanged, gold was unchanged. Silver rallied to nickel, gold dropped $5. Silver rallied to 10 cents higher, gold dropped $10 higher. And at the peak for a while there, let me see if I can find that. At the peak for a while there, before the news came out, gold was down 20 and silver was up 20. And we're talking about the 23rd. This is the gold silver chart, right around here, right around noon. Right. So between here and here, yeah, this is an hourly chart. Had a pretty steep sell-off in gold silver. So silver was being bought, gold was being sold. At the same time, copper was outperforming everything. I believe you have to really be in the guts of this stuff to see if you agree with me or not. But I believe that information, people were hedging the risk of another deal announcement. And all morning before noon, they were selling gold and buying silver because people still have that on. They were also buying copper because it's an economic metal. Trade's going to go on, and it really, really made sense. Palladium. This is obviously in retrospect. I didn't see that at the moment. And then the news comes out, and for a very brief period of time, silver and gold just drop at the same rate, and that's where you have this, right? That's where you have very brief period of time. They start to fall 10, 11 in this area here. And then it stopped abruptly and silver held its own and gold kept crapping out. And so here you have gold getting obliterated while silver holds its own. Now this, someone is covering a trade. I don't know what that is, but take a note this. Note that the gold silver ratio is going down with both metals going down. And that is a reflection of people that are short silver against gold are catching the silver as gold drops. But when the news came out, and that was the news that people are hedging against, when the news came out, what happened? They both dropped. And that's a sign that when they both drop, there are too many longs in gold and not enough shorts in silver anymore. So the gold silver ratio is probably going to be the indicator of the next rally. But until both metals rally when the gold silver indicator drops, I wouldn't be catching falling knives yet. I mean, how can you be unhappy with where the market is? Silver's at $39. This is the worst case scenario. And gold's at $33.60. Anyway, rationalizations aside, that's what I think. That's what's going on. And we'll see what happens at the end of the week. I'm Vince. Have a great day.